Now, with Saudi Arabia cutting crude oil allocations for November by 560,000 barrels a day, well, of course, with the announcement appearing consistent with the kingdom's commitment to abide by an OPEC-led supply reduction agreement, what impact will this have on the market?
Well, let me first start by saying that I think this move reinforces Saudi Arabia's position as a swing producer, and it illustrates Saudi's ability to bear the brunt of the cuts when other producers are lagging. Saudi's action was to cut crude allocations to its customers by an unprecedented amount is clearly supportive of the market. However, traders, from the initial response from traders, I think they don't think that this move would immediately turn around the market, hence why oil prices are just marginally up today. So I think we've already seen this before, so it wouldn't affect the market.
Now, although oil price is up marginally today, we still see it trading below the two-year high of $59 per barrel we saw in September. But do you think the slide we saw last week will continue?
Well, I think it is. Typically, last week was very bearish, of the most bearish weeks in the oil market for months. And typically, oil prices do not do well in the fourth quarter. I think all things being equal, that is, if things do not change, if things remain as they are, I think oil prices should trend a bit lower. I think the fundamentals are bearish. Concerns of overproduction have resurfaced, and unless something happens in Nigeria, something happens in Libya, or something politically happens in Arabia, I think the propensity of a significant rally in the oil market is very limited.
Now, just before I let you go, Adim, what do you think the next catalyst will be to push oil prices higher?
I think one thing we have to look out for is the U.S.'s comments on this Iran nuclear deal. I think President Trump is poised to make an assessment about the Iran nuclear deal, and if he pushes for the deal to be terminated, although it will take some time for sanctions to be slapped back on Iran's exports, I think as long as there's a threat to Iran's oil production, it would send a bullish signal to the market, and oil prices might inch up by, let's say, $2, $3 per barrel. So I think that's President Trump's speech in front of the UN General Assembly is something that might drive oil prices high in the coming weeks.
We'll see how that goes in the coming days. A research analyst at the financial derivatives company, Adim Okwesa, many thanks for your time. Now let's go to Europe now, where the markets are slightly lower as investors monitor the ongoing political uncertainty in the Catalonia region of Spain. Also, French President Emmanuel Macron's labor reform is making waves in France, with most companies on strike. Well, let's see how this is driving the market with Janelle Demalon, who's at the Frankfurt Stock Exchange. Many thanks for joining us, Janelle, today. All eyes are on Catalonia as Puigdemont addresses Parliament tonight. How closely are the markets monitoring this latest development?
Quite closely, as a matter of fact, because there just happens to be a lot at stake. Now, a declaration of Catalan independence would, of course, be technically unconstitutional. The lack of such a declaration could lead to riots and could lead to Madrid suspending autonomy for the region, which would be seen as a further escalation of the conflict. So, in short, it's a real mess, and investors are doing what they can to cover their bases. Now, it's worth noting that out of the 7 Catalan companies listed on the Spanish IBEX index, only one has said that it is not planning to move out of the region, or at least it hasn't announced plans to do so yet. Now, the outcome investors are hoping for is, of course, one of de-escalation, one where Carles Puigdemont holds off on declaring independence, and Rajoy sees this as an opening for dialogue, and the two parties sit down and are able to flesh out a deal which might translate to more autonomy for Catalonia, something perhaps closer to what the Basque country has in terms of fiscal autonomy, in terms of the freedom to spend and tax as they see fit. Now, of course, because Catalonia represents a fifth of Spain's GDP and taxation revenue, this could prove to be a very expensive deal for for Spain, but it would be a deal that is geared towards resolution. Now, whether this is the kind of outcome that markets are going to see, well, that is less certain, because so far Madrid has mostly held on to its position that the referendum in Catalonia was illegal and therefore has no business shaping the country's future.
Now, in France, Macron's labor reform is making waves with most companies on strike. How has the impact been felt in the market?
Well, you have 5.4 million civil servants striking and 130 protest marches organized across the country. So you can be sure that that is hurting business in France. Of course, the point of these strikes is to protest the slashing of the 120,000 public sector jobs, the reduction of sick pay, and other sort of ways to reduce spending on public employees. Now, if you want a sort of concrete example of how this is playing out, we saw that French air traffic controllers are striking. So the country's aviation authorities have asked the airline to actually reduce their flights by a third in order ahead of these staff shortages. But most investors that I've spoken to see this unrest in France as temporary pain for the country that is absolutely necessary. Economists, investors, and in many cases even the employees themselves do see how necessary change is for France. Now, of course, these labor reforms will make it easier for employers to hire and fire employees and allow more direct negotiations between the employers and the employees when it comes to contracts. And this is obviously something that would help the unemployment figures in France, which have persisted stubbornly over the 10% mark and hampered growth in the country.
Well, many thanks, Janelle, for those updates, and of course, we'll continue this tomorrow. Well, elsewhere, KPMG LLP South African unit has appointed 9 new executives in an attempt to restore trust in the auditing firm. The change, which is effective immediately, was initiated by the company following concerns recently raised regarding the audit firm. KPMG South Africa will face an independent inquiry after an internal investigation found its work for companies associated with the Guptas, who were friends of President Jacob Zuma, fell short of its own standards. The company is also at risk of losing some of its biggest financial clients, with Barclays Africa, Old Mutual, Investec, Standard Bank and Nedbank considering their options. Clothing retailer Foschini Group Limited became the latest South African firm to replace KPMG as auditors on Monday, while landline provider Telkom SA Limited said it won't offer the firm new business until the outcome of an independent inquiry. And Mauritius SBM Holdings has made an offer to acquire Kenya's Chase Bank. According to the Central Bank of Kenya, the non-binding offer includes the acquisition of certain assets and matched liabilities from CBLR. If agreed, the proposed transaction is expected to be concluded by the end of 2017. However, there's anxiety among Chase Bank staff ahead of an audit by the State Bank of Mauritius, which is set to take over some employees and branches. Regulators placed the mid-sized Chase Bank under receivership in April 2016 after an unexplained loss of billions of Kenyan shillings. Chase is in the hands of the Kenya Deposit Insurance Corporation, a state body that protects depositors in case of bank failure. When Business Incorporated returns in a moment, a look at proceedings at the IMF World Bank meetings in Washington. Do stay with us.